Great. Yes. Let me know when you can see my screen. Great. Now, great to have you all in this edition of our Investor Lounge. Before we come to our esteemed guest, first, who are we? What are we doing this? DueDash is a platform to make sure that you as a founder can become investable and raise funding, but also make sure that the investors are able to cut down their time and money expenditure to find the right deals and work successfully with them. If you're raising funding or if you're looking for the next investable deals, have a look at our platform, sign up and try it out. And beyond our core platform, we also support founders further, might it be through educational support, credits, discounts, etc. So one part is our Dash Investability course so that you can learn how to build an investable business and answer tough investor questions. We're supported by a lot of great partners. Some of these also sponsor credits and discounts, as I mentioned before. These you can see some of them below. So you also might want to look into these. Might you need a cloud provider? Might you need a CRM or other things to kickstart your business? We are also running demo days. One of them is coming up soon. If you're interested to join a demo day and pitch in front of investors, let me know here in the chat. So you can send me like a personal message and happy to share with you the process to be part of that. With that, I would give it over to Parul to introduce our guest and the session, but let me first pin you both so that you guys are in focus.
Thank you, Michael. Thank you, everybody who's joining in today. Those of you who don't know me, I'm a founder and CEO of DueDash, also a serial entrepreneur, have built a multi-million-dollar companies, invested in private companies in individual capacity for more than 15 years. And I have experience with M&A, basically the whole shebang. And I'm really excited here today to welcome our guest, Tae Hea. He's co-founded Storm Ventures as an early VC fund based out of Silicon Valley. Storm has invested in over 200 B2B software companies, including 11 unicorns, including Marketo, Talkdesk, and Workato, some of the big names out there. And during his tenure at Storm, Tae Hea has also founded Airespace, if I'm pronouncing it correctly, a B2B startup, which was then sold to Cisco for $450 million US, if I'm not wrong. Mm-hmm. And the team also actively invests in Europe, including Germany, which I'm really excited about, and which has led to many unicorns like Pipedrive, Solarisbank, Talkdesk, etc. His experience has led him to co-author a book, which is Survival To Thrival, which is an amazing book for founders who need to find the go-to-market fit, and that's on my next book to read. And Tae has majored in applied math at Harvard and graduated from University of Chicago. He is a trained attorney, and it's really my pleasure to have you here today, Tae. And having been raised in Silicon Valley, I guess it's really hard to stay away from tech. And I believe you're in your 7th fund right now. Tell us about your journey, how you realized investing in startup was important for you, and what role does your background today play in your current venture?
Well, first, I really want to thank you for the invitation and a great introduction. So I couldn't have done it better myself. So thank you very much. So in my case, I've always been interested in startups, and in particular, the whole startup journey. And I did that as an attorney, working with a couple of hundred startups, and now doing that at Storm Ventures. And I find the whole process of the whole company journey to be an exciting and a thrilling adventure.
Amazing, amazing. So it's the excitement of newness all the time, which kind of excites you, which is amazing.
And also the company is like you're building something.
Right.
It's not a transaction. You know, you're creating jobs, you're creating value, you know, you're creating culture. Yeah. You feel like you are creating something.
Amazing. That's awesome. The impact is what drives you. So can you summarize your investment thesis for our audience for a few words?
Yes. So as a firm, we focus on early stage B2B software companies. And venture capital is all about investing in high growth companies. And so since we invest early, our thesis is, how can we help companies unlock growth and become a high growth company?
So it's amazing that you invest in B2B companies, and usually it's kind of tough for investors to evaluate early stage B2B software companies, which are intended to improve the scale of business. So best of class or best of suit products in various industries, and you invest in wide variety of industries. Perhaps you could also share the business models that you like to see and some things that you never would invest in. What kind of evidence do you look for in these companies?
Right. So the two types of business models, well, actually, there are three types of business models that we see in B2B software that we've invested in. The first and most common is a subscription business model, where customers are paying on a monthly, quarterly, or annual basis, so subscription. A second model that we're seeing a lot of, and also very successful, is a consumption model. So you pay based on what you consume rather than, let's say, on a quarterly or an annual basis. And there are companies that will do both of those. So a combination of both as well, too. And then the third would be a marketplace. So we've invested in all three business models, and what we find working well is a blend of these models, where you could have a base subscription business, but then have a consumption for higher usage, or a marketplace as well too. The main thing about business models we find is something that just aligns value to the customer. So as long as customers get value, they're comfortable paying. The challenge is if you ask them to pay a lot before they get value. And so the best business models is where the payment side and the value side are highly correlated. So the customers are always getting some value before you ask them to pay.
There's a typical question about inciting the pain. Is the pain enough for a customer to buy? And usually in a B2C scenario, that kind of is the inflection point or the growth factor. In B2B, it's usually not seen as much as a pain, but more best of class, or efficiency, effective improvements in the workflow. I mean, what is your take on that?
So I have a very strong view on this, is that I have a model of B2B customers, which is someone who's relatively smart, but lazy and want to look good with their boss. And so in other words, by being lazy, it's like the person prefers not to do research, prefers not to do trials, not to really spend a lot of time on this. So the question then is, what will then cause this profile of a person to really start engaging with a startup? And I find that they do that if they have an urgent pain. So what I look for is not a pain or sort of best of class or efficiency or an ROI metric. What I look for first is, does the customer have an urgent pain? If they do, we can build a go-to-market engine around it. If there is no urgent pain, then it's extremely hard to do anything. And so for early stage companies that are going out looking for product market fit, my main advice to them is find product market fit where you have an urgent pain. If you just find product market fit and there's no urgent pain, then the entire unlocking growth will become extremely difficult.
So at DueDash, we have a 5T model for assessing any startup, which is team, timing, traction, technology, and TAM. The B2B scenario of vision, industry knowledge, technical skills, network are essentials for founders to establish a company. As an investor in so many verticals, what are some of the key founding team characteristics do you look for?
So the the first thing that we find that's really important with the founding team is that they have the right product market vision. Because when you invest early in something, there's going to be a lot of change. The market is unclear. And so it's all about making the right product and market bets. So the first thing we look for is, does this team have the right product market vision? And then the second is, we look for leadership and the ability. Are they passionate? Do they have the right integrity? Do they have the right, able to sort of sell their vision as well too, so they can be a leader? And then the third is to drive execution. But the product market vision, we find is something that if founders don't have, it's hard to inject into the company. We can help add people to improve execution, but that product vision and leadership is something that we feel has to be there.
Awesome. It is often said that the past performance do not guarantee future success. I was wondering about the measurement criteria for a success, because as a founder, you're kind of stretched all the time, and the market dynamics change. I mean, we've seen that in the last 2-3 years. I mean, especially the last 2 years have been pretty intense. So when analyzing a company, what filters do you use? And in your opinion, what kind of evidence is most significant? I mean, specifically, I'm taking some examples. Industries like we've seen recently, like metaverse or crypto. So what factors are likely to contribute to founder success, and which ones will not, which can be congruent and which can be not congruent with market dynamics? Some things that you could share with your experience here. Right.
So maybe in a way, I think you're asking about, where do we invest? Okay. And when we invest early, we actually have two very different investment filters. So we invest in two different types of early B2B software companies. And so one company would be exemplified by Talkdesk. Talkdesk founder was an unproven CEO. He I think his first job out of college was actually founding Talkdesk. So it was his first job out of college, and he was learning about building the company and so forth. So if you look from a team perspective, we clearly have an unproven founder. But what we liked about it, and the reason why we invested is that it comes down to your third criteria, is that they were having very good traction. We invested when they were about $1 million in revenue, but they were getting very good traction. And then the other is your fifth criteria, the TAM. It had a huge TAM. In other words, the whole call center and the cloud business, software business, is a $25 billion business. So what we saw is even though he's obviously a young, unproven person, he has very good traction in a huge TAM. And so we invested, and one of the first things that we did was to introduce a person to a company who we knew well. He was a former executive at SAP and other startups, and he joined as the number 2 person and helped this company go from 2 million to 20 million in revenue. So that's sort of one model that we look for, where it's an unproven team, but we feel like there's some good early traction with a very high TAM. Okay. So that's one. The other profile of companies that we invest in are pre-revenue companies. And because they're pre-revenue companies, by definition, they have no traction because it's pre-revenue. And so there, where we invest is really focusing on the team. And so if we really like the team, then we would invest, and the TAM, because we think that'll be a disruptive opportunity. And so those are companies like Airespace, where actually I hired the founders of the company. So we look at it in two different ways, in which one is sort of an exceptional team and a market opportunity, and we'll take the risk of traction, or we see traction with an unproven team, and then we'll work with the team.
Very interesting. So when analyzing—
By the way, it's best to have all five.
Yes, absolutely.
According to your model, but it's hard to have all five. Yeah, there.
Yeah, you just need to see the balance, where's the balance fit.
Yes.
So which are the most critical points for you when analyzing a startup data to evaluate whether to move forward with the deal in the due diligence process or even invest into them?
So we ask our question, can this company unlock growth? If the company can unlock growth, then it could be on a journey to becoming a category leader. And that's something that we feel can be very successful. But if they can't unlock growth, then we know we're going to most likely lose money.
So what would be the determinant factor for you to realize that they are at that pivotal point, or with this cash or the competence that you would bring in, they can unlock growth? Are there certain factors you would be okay to share with us?
Yes. Well, the first one is what you had asked before, is are they addressing an urgent pain? If a company is not addressing an urgent pain, we feel like it's going to just be very hard. And so the first question really about unlocking growth is, is the company addressing an urgent pain? And the urgent pain answers the question, why buy now? Not 6 months from now, not 12 months from now, but why buy now? And it goes back to the model that I have a B2B customer who's, smart, lazy, and wants to look good. And so you need that to overcome that laziness.
So when analyzing early stage versus late stage deals, how much do you rely on data compared to personality evaluation of a founding team and the business overall?
So late stage deal and early stage deals are so different. Early stage deals are before a company has unlocked growth. A late stage deal is a company that is on a very predictable high growth path. And so what we see is the amount of data that you have for a late stage high growth company is vastly more than an early stage company which has not unlocked growth yet. And so the best way to exemplify it is, can you have a junior investor build a spreadsheet model that forecasts this company doubling growth every year for the next 3 years? If you can build that spreadsheet model and really believe in it, then you are a very good late stage company. And investors love to invest in those companies. And so it's about showing the data, and it's about showing that you have a team that can continue to execute that. If it's an early stage company, you can build these spreadsheet models, but no one will believe that it's just a model. It's not based on data because you have not unlocked growth. And in that case, the team is so important because you haven't unlock growth. And so, you're relying the team to do something magical. What we find is unlocking growth is a very magical event for a company. And some companies do it out of luck. Some do it systematically. But it's that inflection between whether you're one of millions of startups or you're a high growth company that's on track to be a unicorn.
Got it. So considering Silicon Valley's dense network and people's tendency to invest with friends or known groups, how do you source deals and perform due diligence, also as an international investor?
Well, companies like Talkdesk really opened our eyes. Talkdesk, by the way, closed the financing recently at like a $10 billion valuation. And so it really opened our eyes to the extent that here's an unproven founder, as I said, just finished college, started this company, going after a huge market of enterprises, which is call center as a service. And he's continued to be a phenomenal founder, CEO of the company. And by the way, he's Portuguese as well. So the company was originally started as a Portuguese company, and most of their employees are in Portugal, even though they have Fortune 500 customers from the United States. So given the success of Talkdesk, Algolia from France, Pipedrive from Estonia, these are all companies we invested when they were about $500,000 to $1 million in revenue with unproven founders. We realized that, it's not just a one-off, but there are a great opportunity here. And so we ended up actively sourcing deals from Europe, and we've done 3 investments like just in Berlin itself. And so the way that we source deals is a combination of building brands so people know about us. And we find the best way to get founders to know about us is helping them with their #1 question, which is how to unlock growth. And so we share our unlock growth methodology with founders. And so that's one. So that's how we become top of mind. And then the second is to work with the local VCs, whether they're in Berlin, whether in the Baltics, or Chicago, or Florida, anywhere outside Silicon Valley in a way, work with local VCs so that we can form syndicates with them. And our fund size, and we picked our fund size to optimize that. What I mean by that is we just closed our 7th fund, which is a little over $200 million. And $200 million is big enough to lead and go multi-stage, multi-round on with early stage companies. So it's not like a seed fund that invests once and you're done. So we can invest through the company journey. But at the same time, we're not like a multi-billion-dollar fund, so we're okay getting relatively small ownership. We don't need that 20% ownership target of the billion-dollar funds. So it's easier for us to fit into a cap table. And what that means is like our $1 million investment in SalesLoft generated, I think, around $35 million return for us. And on a $200 million fund, it's a nice return. It's like, 16%, 17%. If you're $1 billion fund, it's 3%, which is nothing. So we picked this fund size to really make it so we can partner with the local VC ecosystem.
Amazing. Congratulations on that success. So
what
are your views on the current way of sourcing deals? Is it going to stay like personal networks, or what do you think would be the future of sourcing, considering investments are becoming more and more global and potentially new generation is coming into the whole thing?
Yeah. Referrals by itself doesn't scale. So the old Silicon Valley method that we had, which is just referrals within Silicon Valley, which worked for us extremely well, like in 2005, would not work for us now. Back in 2005, 95% of our investments were in Silicon Valley. And in that case, the referral network system works extremely well. But now that we're investing globally, and there's great startups all around the world, like in Europe or in Asia, we find that people like yourself, accelerators, incubators, seed funds, are playing a huge role in this whole process, and other founders as well too. We just invested in a company that came to us initially as sort of a cold outreach. That is something we never would have done.
Wow.
But what happened is that it was a cold outreach, but it was a very interesting company. And then we looked on the homepage, and right there, their lead customer quote was a person who was a former EIR at Storm. He's a chief security officer at a public company. And so we immediately called him, and he said, this is great. So it's a cold reach, but we're able to quickly reference the company. And so that's what we're finding is that because we're investing globally, we have a global network that helps us like due diligence, and makes it easier for us to handle all these inbound leads that we get.
Gotcha. So there is some level of pre-due diligence that you kind of expect coming through these different networks. And of course, in DueDash, founders can create structured company profile. They have a secure data room from sharing their one-pager to pitch decks. And from there, if it is a good fit, they can build the investor engagement.
Oh, it's extremely helpful. I mean, having someone that you trust just screen something, it just saves time.
Yeah.
It's the first thing you always wonder is, should I believe this?
Right. So,
and so if it comes from a referral or an institution like, yourself or a seed fund, whoever, you at least believe what they say is right.
Yeah.
You may not want to invest, but at least that's a big step forward in our process.
Right. Startups can share their updates also from the platform here, and they get a complete ecosystem, and investors can have the all aspects of deal flow, due diligence, portfolio management. So it's a complete exchange from both sides that we are trying to create digitally.
Yes. And I think that's going to play a bigger role going forward, just because of the fact that investors are investing, more globally, and great startups are emerging from everywhere. And as an investor, our best due diligence is just watching a company over time. And so having a platform or having a company just keep us updated is the best way for us to sort of understand how the company is doing.
Awesome. So, Tae, you have witnessed numerous meltdowns and recessions, and at the same time, you've been investing in innovative, disruptive, scalable businesses. In your opinion, how has venture capital industry changed in the last decade or two? And do you think things will change in VC industry, or will they continue to be done the same way as they are being done now?
Oh, the venture industry has changed phenomenally over the last 20 years. I would say it's become much more global and much more efficient. It used to be a very local clubby network. And so, we here on like Sand Hill Road would get together, talk about deals, and we just like form syndicates, invest in companies that we can drive to. That was like a key criteria. Can you drive to board meetings or not?
Mm-hmm.
And the funds were much smaller. And so small funds mean that you syndicate more often and just collaborate together. Since then, venture has just vastly increased in scale and in becoming global as well too. And with scale and global, it's become much more efficient.
Do you think the bigger the funds are, that's kind of also increasing the complexity for the fund's operations?
It does. I mean, in any organization, the bigger it is, the more complex to manage, Sure. But what we see is the market, in my mind, is really bifurcated into two, and that is whether you're a high growth company or you're not. You know, if you're a high growth company, then you're in a situation where there's a lot of investors with a lot of money that wants to invest in high growth companies. If you have not unlocked growth, then there are investors, but there's just so many companies, and investors are generally reluctant to invest, and so it's a very different world. And so we see the market bifurcating into those two markets.
So you talk a lot about growth, and you are a growth specialist yourself. I'd like you to share some tips of how founders can achieve repeatable growth, and what factors should they strive for in order to succeed in the long run. And in addition, should they be looking for, when should they be looking for repeatable growth? And when it comes to investing, what potential do you see at a particular stage that can be unlocked for them to become a unicorn?
Right. So we have a methodology for unlocking growth, and we used as a metaphor surfing. In other words, you want to go from paddling to surfing. So paddling, it feels like founder-led growth, where you burn a lot of energy to go a short distance. Whereas when you surf, you know, you have the wave pushing you, and so you feel momentum. And you need that to get to high growth. And so when you go from paddling to surfing, the key thing is, and surfing feels like when you're scaling growth. So the scale growth phase is like surfing. And so when you want to go from paddling to surfing, the key thing is you have to catch the wave. And catching the wave, we say, is what unlock growth is to catch the wave. And what the way to do that is to basically combine the wave with, you know, the surfboard. And the wave in this case is the customer journey. So it's really understanding the customer journey and combining it with your internal go-to-market process, your playbook, which is a surfboard. So at the end, what you need is you have to combine the two, and that's building what we call a customer journey-driven playbook. So your go-to-market process is firmly tied with the customer journey. The customer journey explains what the customer wants and when. The playbook and process is what your go-to-market teams do and when. So you want to make sure those two match, and then you have something that is a repeatable, scalable process that makes customers happy, and then you're in a position to grow. And then I start off by saying, what begins this customer journey? And I say the customer journey always begins with an urgent pain. If there's no urgent pain, it's like, why should a customer engage with you? And so it starts with an urgent pain. The next step in the customer journey, you know, once they have an urgent pain, is why you? And that you need a compelling wow to sort of persuade them that, you know, you're the right person. And so we walk through this customer journey in terms of what it is, and then build the process with it. And so what we find is, if you don't have an urgent pain, it's just not going to work. You know, if you don't have a wow, also, it's just not going to work. You just don't get conversion. And so that's what we do, is put this together. And at the end, excuse me, it's coming out with this customer journey embedded with the playbook is how, you know, you catch the wave.
Awesome. Thank you for unpacking that for us. So now I'll ask you a few quick questions that you would need to answer in quick 1 or 2 sentences. Let me know when I'm ready.
Okay, sure.
Great. So a great 1-minute introduction that should contain the elements to an investor like yourself, what should that be? That should include both introduction for a person and a startup altogether.
Yeah, just something about yourself and why this will become a category leader.
So what are some of the latest trends and technology that you're watching and you feel strongly about?
So we're very interested in combining AI with SaaS to build intelligent workflow. We feel like AI plus SaaS will be applied in every application and every process.
Very interesting. What sectors and industries do you think will struggle?
Well, we're in or about to be in a recession, so any sectors with low ROI will have a difficult time.
So any idea that you think should be worked upon and nobody has ever tackled that before?
I think there's so many processes that can be automated with AI and SaaS. So we just invested one in semiconductor, but I think, there are just so many of these vertical applications.
Share one of the craziest idea that kind of just pops out right now that was ever pitched to you.
Well, it was a medical idea, but I didn't know anything about medicine, so I couldn't say whether it was good or bad. But it was a cure for some, very common ailment.
I see. Who is your childhood inspiration?
Was a military leader. It was General Patton. I was very much into military leaders.
Interesting. What qualities do you value most in a professional relationship?
Trust.
What drives you when you get up in the morning?
Just working with people that I like to work with.
Awesome. What are you currently reading? Or maybe in your case, I can ask, what are you currently writing on?
Oh, well, I'm reading, actually, I'll answer both. I'm writing right now our new methodology for unlocking growth, and I'm about to read a book called 5 Dysfunctions of a Team.
Awesome. That's amazing. That's going to be a great value, I guess. I'll be looking forward for the release of that book. And any advice to those contemplating to investing or who have just begun this journey? What would you like to say to them?
It's an exciting journey. So I wish people the best of luck, and I encourage people to start journeys, especially now as we're going through a difficult macroeconomic time. Usually this is the best time to invest and start companies.
Amazing. So I'll take some of the audience questions now. One of the first question is, do you think theme-based investments as an investor and even startups, is it a great idea? What is the scalability of these theme-based investments? So for example, let's say companies involved in femtech or metaverse, can they attract late-stage investors even if they receive early investments? Any tips that you can suggest, and also a way to figure out where on these themes is the cash there on the wave overall?
Yes, so I'm a big fan of theme-based investing. And so when I first started investing, I was really, my theme was mobility. And so I invested heavily in mobility. And right now, my theme is this sort of AI plus SaaS to do intelligent workflow. I think theme-based investing is really great. It's basically like trying to surf the wave. And so the wave is the theme. The main challenge is you just have to pick the right theme. And sometimes, as you were talking about with like crypto, is that markets can go through sector rotation. And so when the sector rotates out of your theme, it becomes painful.
Right. I think there was one more interesting aspect in that question. Is there a way to figure out where the cash is riding on that wave, like I think on the journey? Because even if you attract early money, if you have to go to the next level, how do you know if the money is still there at a later stage or not?
The best way of knowing is that if you can sustain the growth rate, the money will be there. So it's about sustaining the growth rate with good unit economics, which basically means you're building a great business.
Gotcha. So there is a question that we are a B2B startup with a hyper growth and a 300% CAGR with our first year and have hit 1.5 million USD, and we're just entering the second year. We are not a fully digital startup. We still lack digital things, but we've planned to put more digital solutions in terms of technology and drive growth and deliver better solutions and products. And they see a lot of opportunity. Do you think this startup has a good chance to get funded by an investor?
I think the fact that it's tripled is will definitely attract a lot of interest. And so I think, you'll definitely get investors to engage. Whether someone invests, I would have to learn more. In other words, it's about, can they sustain that growth rate? And it goes back to one of your 5 points about TAM. So initial traction is very good, but can they sustain the traction, and how big is the TAM?
Yeah, and tech will come into the play then. The due diligence on the tech will kind of come in, and can the team execute on both dimensions?
Yeah, I like your 5 T's. So I have it right here and I'm applying it. Yeah.
Awesome. Amazing. So the next question is, do you have a thesis to invest in emerging markets, especially like countries in Asia, Bangladesh, and if at all, then what would be, let's say, your connections there, and so that they can be connected with you?
Right. So we've made several investments in India already. And it's also relatively easy because probably about a third of the Silicon Valley founders that we've invested in also Indian as well too. So our investment strategy is focused on B2B software. And so we're looking for B2B software customers primarily based in North America, but also in Europe. What we found though with the cloud, with AWS, GCP, and Microsoft, is the cloud has made Silicon Valley technology available everywhere. So you can have a Bangladeshi startup build on top of AWS and sell to US customers. And that will be a type of company profile that we would find interesting.
Great. I think that's a great input to all the founders today who are listening in.
Yeah.
The next question is, do you invest in media industry like television or feature film projects? Are those projects, would those be like a media projects interesting for you?
So we would not do a media project because we would view that as B2C. But if it was related to media production, things like that, that would be more, we could look at it B2B. The reason why, I'll tell you a story, is why we don't do B2C. So the reason why we don't do B2C, by the way, is a great area and it's a great place to invest. So it's nothing bad B2C. In some ways, B2C investment is bigger than B2B investments. It's just that I love playing games. So I invested in this Korean game company and it did really well. So I was happy with the return. But I found every game that I liked didn't become popular. And so I've learned that to be a good B2C investor, you have to have an intuitive sense of what things are going to be popular. And I didn't quite have that. So I realized that I don't have the DNA to be a B2C investor. However, I could understand why businesses buy things and how to sell to businesses. And so that's why I felt I had the DNA to be a B2B investor.
Gotcha. I can totally resonate with that. So it's a similar thought process there. So the follow-up question is a similar startup in the industry focused on art and entertainment, but for mental health using AR and VR, but more research R&D based business. Would that be interesting for Storm Ventures?
Well, we have actually invested in a related company, a company called Limbix.
Mm-hmm.
And what they do is they use VR as a therapy for mental illness.
I see. So was that a B2B business, or what was the thesis?
Yes, it's a B2B business, yes.
I see. Okay, so anything to do with B2B, and that should be
B2B software, yes. We tend to minimize the hardware side.
right. That's amazing. So any advice, if you had to give one advice to young Tae Hea, what would that advice be?
I think, doing startups, being a founder of a startup is a fantastic opportunity, but very challenging. So just make sure you pick the right journey.
And what would be the ideal journey? What would have been an ideal journey for you?
I think it's having that right product market vision, because think of us like the early explorers around Christopher Columbus. Most people thought the world is flat. But at that time, if you had a globe, if you had the right vision, and so you have this sort of globe of the world, you'll be a much better explorer. And so just making sure you have that right product market vision will put you in such a better position, because everyone is exploring, trying different things, working hard. But if you have the globe and everyone else thinks the world is flat, then, you'll get to the right place faster.
So next question is, any countries or regions from which you expect a lot of innovative and impactful startups to come from in the next decade, and where you are keeping an eye on investing in?
I think there'll be, in our space of B2B software, a lot of companies emerge from both Europe and India.
So how do you assign a valuation to a company that has some sales, but mostly a potential to achieve a high valuation?
So what we do is a combination of two things. Is we have a spreadsheet of valuations that are sort of being paid. It's like when you buy real estate, you sort of look at like, what are the neighbors getting paid, sold? And so we have an idea of what comparable companies, valuation for comparable companies. So that's one. So you look at like comparable valuation. The second valuation analysis that we also do is, and so it answers the question, is this a fair valuation? So the first one is, is this a market valuation? Is it fair? The second question is, will we make money? And so we ask that in two ways. One is whether we think the next round will be at least double the price. Because if it's not double the price, it's like, why invest now? Invest next round. So whether the next round will be more than double the price. And then the next other question is, at exit, can we make, like 20x?
Gotcha. So this is a very interesting question. Founders are still mystified about TAM, SAM, and SOM. What is, in your view, the best way to define the TAM, the SAM, and the SOM for a given market?
Well, I think if you're talking to investors as an early stage investor, my suggestion is don't even talk about it. Okay. Just talk more about how you're going to get to 100 million in revenue. The reason I say that is many times by going into those three words, you start getting into definition. Investors and you may have a different definition. And so you don't want to spend time arguing over definitions or having people misinterpret what you're saying. It's more compelling to just show how you're on a path to 100 million in revenue.
So what KPIs as an investor would you look for to convey that they are on the right path or they have achieved the product market fit, and also founders' understanding of their clients and market?
Right. So the KPI, there are two types of KPI that I use for product market fit. The best KPI is net revenue retention. And that measures do existing customers buy more or less. So if you have product market fit, then your existing customer should buy more. So it turns out net revenue retention is the best metric for product market fit. The problem with net revenue retention is that it's a lagging metric. You know, you have to wait at least a year typically before you get there and so forth, or maybe a few quarters. And so it's a lagging metric. And so you also want a leading metric for product market fit. And there, it helps to come up with the right usage metric. So the right usage metric will help you as sort of an early indicator of whether you have product market fit, but ultimately then is tied to, do you have good net revenue retention?
So it's a very interesting question for an early stage founder who's probably even at an idea stage. So they need to find investors, because it might seem to some extent that it's of course it's risk capital, but potentially gambling with somebody else's money. So, and investors are obviously not waiting for founders to approach them. So what is the best way, or how should they go about finding the investors in the very first place? How should they engage with them, and what should they engage investors with?
I think there the key is really about qualifying the investor. So if you are a company which is sort of pre-product, you just have to find an investor. It's really about qualifying the investor for someone who's willing to invest at that stage of company and has some passion for that space and for the team itself. So qualification becomes extremely important.
What is your view about privacy tech going forward, the market for privacy and potentially, I think, tech around that?
Yeah, no, I think privacy, like GDPR compliance and others, is compliance in general is a very good market. So yeah, we are actively looking in that area.
There's a question from a person who consults in creating sustainable operational frameworks. And I mean, of course, in startups, we talk a lot about passion, vision, idea, execution. So when the scaling happens, there's a lot of, continuous firefighting and micromanagement that's needed. So are there any models or certain factors that startup founders should watch out to? When should they start thinking about processes and frameworks, creating the OKRs and all those internal KPIs? What are the right triggers for those decisions?
So building process is absolutely critical. You can't scale without building process. And so find that even at an early stage, as you're finding product market fit, it's good to have a process for how you find product market fit. So I'm a big fan of having process early on. It's just the right process. And the challenge is that I would not start instilling a lot of go-to-market process until you have unlocked growth.
Okay. There's a question around B2B startup that has offices in India and UK to give sustainable and healthy food and beverages worldwide. But I'm not sure, it's not a software product, so I'm going to skip that. Then it's a B2C, so I think we're going to ignore that. There's one question around electromobility, last mile electromobility platform based out of Europe, not incorporated at the moment, but they are getting favorable feedback from one of the large OEMs here. And they were willing to give access to their ecosystem to fine-tune their first prototype. So what would be your advice for these people to engage further in terms of funding with a professional VC? Would this be the right stage, or should they go ahead and first get the prototype right and then go for a VC funding?
I don't really know enough about the space to give, great advice here, but in general, it's good to show that basically the dogs like the dog food, is that the users are actively using the product, and so if you can show that, then that's a key milestone.
Sure. So what KPIs do you think are best for a real estate marketplace?
Ultimately, GMV is the key metric that everyone will be tracking. And then second is, you need to have a balanced marketplace. And the third is, can you cost effectively build both sides of the marketplace?
Should GMV remain as a core factor for marketplaces, or should there be some other KPIs they should take in conjunction?
Well, you need other metrics, like there's the take rate. The revenue is GMV times the take rate. And so revenue is what people would be, because that is what the revenue that comes in. But for marketplaces, the leading metric at the top is always GMV.
Right.
GMV, then take rate, then you get the revenue. And then the question is, can that GMV keep growing exponentially?
Awesome. Well, it's been fun talking to you. And I know you are on DueDash platform, and the founders who are out here, they can reach out to you and through the platform. And I hope you would consider that. And
no, that's very helpful.
And I know you'll be able to find some amazing startups on DueDash, and looking forward to your engagement there. And for listeners, if you guys liked it, I'll be unpacking some of the learnings today that we gathered on social media. So please feel free to share it with your friends and other network people as well. And please set up your profile, those of you who haven't done that. And we continuously verify the startups who join the platform and share it with the curated investors that we have who like to engage with the deals directly as well as outside the platform. So great that everybody could join. Thank you so much, Tae Hea, this morning. I know it was early for you. Thank you so much for joining and sharing the insights with all of us today.
No problem. Enjoyed it. Okay. Thank you very much.
Have a great
Okay.
Thanks.
Goodbye.